Welcome back to Explain the Charts. Today, September 17th, 2025, we're doing a deep dive into the SPY, the S&P 500 ETF, which is currently in a fascinating position near all-time highs. The overall sentiment is quite bullish, with the S&P 500 and Nasdaq recently hitting fresh records, largely fueled by robust demand for AI infrastructure and strong corporate earnings. Investors are eagerly awaiting a key Federal Reserve interest rate decision this week, with strong expectations for a quarter-point rate cut. This anticipation has been a significant tailwind for the market, driving optimism across various sectors. Let's unpack some of the primary drivers. Second quarter earnings for the S&P 500 saw a surprise rally, with actual earnings growth at an impressive 11.9%, significantly beating analyst estimates. Approximately 81% of companies surpassed both earnings and revenue expectations, and forward guidance indicates strong management confidence. Companies like Seagate and Western Digital have surged due to booming AI data center demand, while Alphabet hit the $3 trillion market cap milestone, reinforcing the tech-led rally. The Magnificent Seven tech giants continue to be a powerhouse, posting 26.6% earnings growth in Q2 and expected double-digit growth for the next 4 quarters. However, it's not all smooth sailing. Some cautionary notes are emerging. There's a palpable risk of a sell-the-news event following the Fed's rate decision, especially as the S&P 500 has shown unusual resilience, going 29 trading days without a 1% drop. Historically, September is often a volatile month, delivering the worst monthly returns for the S&P 500, attributed to seasonal portfolio adjustments. Furthermore, market breadth has been negative, meaning gains are concentrated, with sectors like consumer staples and healthcare lagging. NVIDIA, a bellwether for AI, even saw its stock dip recently amid reports that Chinese tech firms might halt chip purchases, highlighting geopolitical risks. So, while the market has been on a tear, we need to remain vigilant for potential short-term pullbacks. Now, let's turn our attention to the daily chart to see how these events translate into price action. Looking at the broader picture from May 2024, we can clearly see a strong, sustained bullish trend. The S&P 500 has been consistently carving out higher highs and higher lows, indicative of strong underlying momentum. Notice the impressive run since early April 2025, where the index rebounded sharply after a brief consolidation. Zooming into the period around April 2025, we observe a significant reversal. Following a notable dip, the SPY surged dramatically on April 9th, jumping over 11% in a single day. This strong move from the low of 481.8 could very well be correlated with the positive Q2 earnings surprises and the escalating demand for AI infrastructure, signaling a renewed confidence in the market's growth trajectory. Moving to more recent action on the daily chart, the SPY has pushed to new all-time highs, with a peak of 660.91 reached on September 15th. However, the candle for September 16th shows a slight retreat, closing at 660.0 after opening higher. This small red candle, following such a strong rally, could be an early indication of profit-taking or the market digesting the rapid gains, aligning with the short-term extended warnings from analysts. Shifting our view to the 1-hour chart, let's examine some intraday volatility from early September. Specifically, on September 5th, we saw a significant hourly drop, with price falling from 651.63 down to 644.14, a substantial decline on high volume. This sharp move downwards, albeit temporary, could be seen as an initial manifestation of that seasonal September weakness or early sell-the-news behavior even before the Fed announcement. Despite that brief dip, the hourly chart shows a strong recovery thereafter. The market quickly found support and resumed its upward trajectory, pushing back towards the 660 level. This resilience indicates that dips are being bought up, suggesting underlying strength and bullish conviction in the short to medium term. The area around 650 served as a key support during this recovery phase. Now, for the very latest, let's look at the 15-minute chart from September 15th and 16th. On Monday, September 15th, the market closed near its all-time high, consolidating around the 660 to 661 mark. However, during Tuesday, September 16th, we observed a slight downtrend throughout the day. While still trading at elevated levels, the market showed signs of mild selling pressure after hitting those fresh records. This short-term weakness, consistent with the daily candle, suggests that traders are exercising caution ahead of the anticipated Fed decision and the potential sell the news reaction. The 660 level is acting as immediate resistance, with mild support appearing around 659.50 on this time frame. Recapping our analysis, the S&P 500 SPY is fundamentally bullish in the long term, driven by strong earnings and insatiable AI demand. Key long-term support levels to watch are around 550, and then more critically, the 480 to 500 zone from the April 2025 lows. In the short term, the market is currently consolidating around the 660 to 661 resistance area, reflecting caution after recent record highs. Immediate support on intraday charts can be found around 659.50 and then more significantly at the 650 level, which proved resilient during early September's volatility. So, what's next for SPY? An unbiased prediction suggests continued upward momentum towards the 7,000 price target in the medium term, as indicated by strong forward earnings estimates and sustained AI growth. This is reinforced if the Federal Reserve delivers the expected quarter-point rate cut and provides a dovish outlook. However, a short-term pullback to the 650 to 655 range is highly likely, perhaps with 70% probability, especially if the Fed's commentary is not as dovish as anticipated or if sell the news profit-taking materializes, pushing prices down to test these established support levels. Traders should monitor the Fed's announcement closely, as well as the trading volume and market breadth post-decision, looking for signs of concentrated selling in the tech sector, which could accelerate a pullback. The market's ability to hold above 650 on any significant dip would reinforce the underlying bullish trend. Thank you for joining Explain the Charts, and happy trading!